So we have platforms, three large, one which is smaller, which have suffered and which now represent 6% of our international portfolio. You know what they are. You know what these platforms are. They're huge structures. They're miracles of engineering, and they can cost $1 billion. So what truly matters here is that they are absolutely essential. These rigs are absolutely essential to produce 1/3 of the oil and gas which are used on a daily basis. They're absolutely essential. So what the companies do that we have in our portfolio is they order these rigs from the world's leading shipyards, Japan, Korea. They receive them, say, 3 years after, which is how long it takes to build a platform. And with good maintenance, they can last perhaps 40 years and sometimes even more than 40 years. To keep things very simple, what they then do is they lease it to the oil companies. So it's interesting to compare with another business, real estate. It's like floating real estate because these are assets that are very, very valuable with a very long life, and they are profitable insofar as they are leased. But there's something special. There's tremendous degrees of volatility, much more than there is in the field of real estate. This is important, and I'll explain why it's important, because we need to understand their performance. This is a look back over 25 years. This is a special kind of a rig. This is a jackup. These are not the more common assets. They're not the more volatile. They're used in shallow waters. But we understand these are assets that have been rented out for as cheap as $40,000 a day and as expensively as $230,000 a day. That's volatility for you. That's extreme volatility. And by the way, after this recent minimum, they're beginning to recover. That's very important. So if we were to talk about the rigs that are used for super deep waters, it's very similar. The more recent maximum in the cycle was back in 2013, 2014. They were being rented out at $600,000 per day. They reached minimum $130,000, $140,000 per year a year ago, and now they're beginning to recover. And now they're at about $220,000, $230,000 per day. So as I said, this is important. This is important. We believe this is essential. We need to understand this chart. This chart is 40 years worth of history of Valaris's value. This is one of the companies we have in the portfolio. That's the white line. The yellow line is the price of leases for these rigs. And you can see it perfectly well. It really is the essence of a cyclical model. At the 80s, it was going at $27 per transaction. A couple of years after that, it drops 97%. So basically, you're lost, and it's at $0.4 per share. In a couple of years, it recovers and multiplies by 16 or 17, so it's up at $7. Again, it drops, 90% is lost. The minimum is at $1.1. Then it multiplies by 70 10 years after, times 70. That's a lot of volatility. You can't really see it. It's very jagged, but as you can see, what is important here, it's that times 70. It seemed as if the company were going to disappear. It was worth nothing. Again, it plummets to 9. Again, another maximum, multiplying by, 10 to reach 82. And so far to date, what we see is the company now is at 1.4, 1.5, and that's another minimum, which we have seen has happened before. These violent, very, very, very frequently, very violent swaying movements. We do believe it will recover perfectly. We didn't buy it at the minimum. We have a rough cost of $8 in Valaris, but if you look back in time, you'll see how very important it is to buy not when they're at their floor level, but when they are very affordable. Our analysis is that the future is going to be very similar to the past, and that's why we think it's important to hold on to them. So we may be wrong, but we're convinced. Afterwards, if you want, do ask us, and we will be happy to go into the specifics. I understand that volatility is very uncomfortable, and actually these companies, on any given day, they're up 20% or down 20%, but we believe that withstanding that volatility is well worth our while. Now, on this slide, we're going to see a little bit more clearly how this opportunity becomes numbers. When we presented, it was at this price. Now it's at 1.5. But what is very important to keep in mind is to think about the value, the difference between price and value. And we've specified 3 different methods. One would be the steel value. That's of those different independent valuations that maritime brokers and specialized consultants, on the basis of transactions that take place in this market, that would be similar, if you will, to real estate activities in the real estate sector. So these experts who look at Valaris, net of the debt divided by the number of shares, will give a value per share of roughly $19, which is a multiple of what the current price actually is. If we see our valuation normalized, which is looking at a price which we calculate, the Valaris price would be $60 per share, which is incredible if you see what the price is. But in the past, it has been worth $80. So we believe that this is a solid alternative. And if we look at book value of the funds themselves, in other words, if we think about what accounting tells us after having written off and after having amortized some assets ever since 2014, when the crisis was unleashed, we see that it's 47.2. So the potential is truly spectacular. So this is basically what happens in our investments in the sector. The numbers might vary a little bit, but the idea is very, very similar.